bonded. We're going to talk about what a bond is, what the bond relationships are, the history, types of bonds, the surety requirements, and I'm going to explain all this later, but surety requirements, bonding limits, and some frequently asked questions about bonds. In this picture you can see some guys just enjoying themselves on the job site, except for the one in the middle, kind of looks a little angry. Alright, so what is a bond? A surety bond is a promise to pay one party, which is the obligee, the owner, and the owner is the obligee, and you have a principal who is the contractor, and the surety, which is the insurance company. And so when you have a principal who wants to work for an obligee, you have to go get a bond. And so what a bond does is it ensures that if the principal fails to complete their obligation to the owner, the surety will provide either the financial means to complete the project to the principal, or else get another contractor for the obligee. So it kind of just puts a assurance there for the owner that the job will get done, regardless of whether the contractor is able to fulfill its obligation to the contract. And in the end, the obligee is protected against losses resulting from the principal's failure. So a surety is the insurer, which in the old days used to be banks. Banks used to do bonds, but in like 1890, the Supreme Court ruled that banks could no longer do bonds, so they had to do, so now insurance companies or strictly bonding companies are the ones who give out bonds. And there's a lot of different kinds of bonds you can do. Obviously you have like bail bonds and like bonds that you would get if you wanted to like start up a car dealership and stuff like that. Contract bonds are specifically for construction, and that's what we're talking about. So yeah, the principal is the contractor, the obligee is the owner, the surety is the insurer, and as you can see in this picture here, you have the relationship between the obligee, principal, and the surety. So the principal has a bond between the obligee to perform their duties, or else the surety, if they fail, then the surety has a contract with the obligee to pay that money to get the job finished. So a lot of times when contractors are not going to be able to fulfill the contract to the price, they default on the bond, and the surety will sometimes will finance them to finish the job, or else they may just get a whole new contractor. It just depends on the situation. And then the relationship between the principal and the surety is the indemnity agreement, which I'll get to. So principal, obligee. The duty is the principal has the duty to the obligee to perform its contract. So principal to the owner, they have to build a building for whatever they agreed on, whatever price, in the right time. And then the obligee to the principal is that the obligee will pay the principal whatever they agreed on that set price. So that's the obligation to the contractor. The surety to the owner is that the surety has a duty to the obligee to take action under the terms of the bond if the principal defaults under the contract. So assuming that the contractor fails, the surety will make sure that the job will get done. And then the obligee to the surety is that if they fail and the surety ends up taking over the project, the obligee, the owner, has to make sure that they fill their end of the bargain that they had with the previous contractor with the surety. So if the surety goes out and does it, if they get another contractor, they owe them the same amount of money that they would have paid the other contractor. So that's the other obligation of the bond and relationship between them. And then you have the surety and the principal, which is in essence the indemnity agreement. And the surety has the duty to the principal to determine whether the principal was in default and abide by the terms of the bond and any agreement of indemnity. So if there's a claim made against the principal, the surety will be the one to determine whether or not they were actually in default, if they violated the terms of the contract and stuff like that. And then the principle to the surety is that they must cooperate with any investigations, allegations of default, and also reimburse them for whatever losses they may incur. So a little bit of history of bonds. In 2750 BC, that's the earliest known suretyship contract written, and it was in Mesopotamia. So that's like a long time ago. They've been around for a long time, but they weren't even, they didn't even have written law until 150 AD, which happened in the Roman Empire. And then in 1837, William L. Haskins proposed the first surety company in America. 1894, Congress passed the Hurd Act requiring surety bonds on all federally funded projects. So yeah, if you're going to work on a federally funded project, you have to have a bond. There's no way around that. And then in 1935, they had the Miller Act passed, which requires public work contracts exceeding $100,000 to obtain performance bonds. And it also mandated payment protection for contracts exceeding $25,000. So that's the federal law. Each state has their own, what are called Little Miller Acts, which are similar, and they're all about the same. And they just require bonds on jobs over like $200,000 or whatever they make it. And then in 2003, this is an unrelated type of surety, but surety insurance companies, including AIG and Travelers, paid an unheard of $900 million settlement to Enron customers following the crash. So Enron had a bond. They failed to fulfill their end of the bargain, and then when they crashed, they got caught for some scandal that they had. The whole company went down, and the insurers of the bond had to pay out $900 million, which was the most ever. So you got types of bonds. You have a bid bond, performance bond, and a payment bond. Bid bonds, they guarantee that the bidder is, if they are selected as the lowest responsible bidder, that they will fulfill the contract. So in order to bid on a project, you're going to have a bid bond that says, if you pick me, I will do this, and you're locked in at that point. So it guarantees the contractor will enter into a contract if determined to be the lowest responsible bidder, and guarantee the contractor will provide the required payment and performance bonds and insurance policies. So it also binds you into getting future bonds, which are the performance and payment bonds. The performance bond guarantees the performance of the contract requirements at the stated bid price. So it requires you to perform the duties that you agreed to at the price you agreed to. In effect, the surety is saying it guarantees the performance of the contractor, or it will complete the project as described in the plans and specifications. I kind of already went over that. The surety is guaranteeing the work of the contractor. Payment bonds. They guarantee the contractor to pay the subcontractors and suppliers. So you don't want to have your contractor fulfilling their bond by completing the project within the price range, but shorting their subcontractors. So it requires them to pay their subcontractors an agreed on price. And that's part of the Miller Act of if you have jobs of like $25,000, like subcontracting jobs, they'll have to get a bond. Okay, so if you want to get a surety as a contractor, they basically find out every single thing you've ever done, and every single dollar you've ever made will be theirs if you don't fulfill your agreement. So there's a ton of things that you have to do. You apply for the bond, and then they basically write down everything that you own and everyone that you know in case you don't fulfill it. So they take your resumes of key personnel in the firm, list of work successfully completed, names and addresses of owners, designers, suppliers, subcontractors, general contractors, your friends in the business, organization charts, they require that, and responsibility of key individuals in the company. You got to show them what your safety plan is, what your future business plan is, explanation of how the project fits with the company's other work. They're going to go and look at your past projects and see what you've done before, make sure you have the capabilities of doing the next project that you're about to enter in on. The company plan, risk management, safety programs, safety performance, all your business relationships, financial information, personal, your credit, your progress. You have to present them with progress, expected progress and all that stuff. Yeah, so bonding limits, you don't want to, you're going to have some bonding power. If you're a large company, you're going to have a lot because you have a lot of capital and you have a lot of money already in the company, so you can bond a lot. Like the more money that you have, the more that you can bond with because they see you have more assets, so they'll give you larger bonds. But you don't want to over bond, like use all of your bonding capacity on one project, stuff like that. Like you typically don't want to use more than half of your bonding power on one project. So due to the fact that bonding companies want to be successful and the fact that bonds only cost 0.75% to 4% of whatever you're bonding out, the failure rate has to be extremely low. So the insurance companies, the sureties, are extremely careful about who they select for bonds. They're very picky, and the more risky you are, it's all based on the amount of level of risk that they're engaging in with taking you on as a partner and underwriting a bond with you. So the more risky you are, the higher your rate's going to be. So if you're proven, you know, if you've been with them for a while, you've gotten a lot of bonds from them, your price will probably be a lot lower. But yeah, so your first time, you'd probably expect to pay a lot more, a higher percentage of your bond price. So yeah, it's a function of how much risk there is involved. So as a rule of thumb, contractors, they usually are bonded up to 10 times their working capital or 4 times their net worth. And so working capital is the current assets minus the current liabilities. And then no more of half the contractor's bonding capacity should be used on any single project, because you're going to want to be, as you're working on one project and you're starting to close that project out, you're going to be wanting to bid on the next project. And if you have no bonding capacity, you can't even bid on the next project. So you don't want to use it all in one place. And if you do default, you don't want to have that much, 100% of your bonding power defaulted on. All right, so frequently asked question is why can't I just buy an insurance policy? And the difference between bonds and insurance is that in an insurance policy, you're transferring risk between a company and then a pool of other people who have similar risks. And so you're all contributing, and there's no, and there is somewhat of an expected loss, like you're expected at some point to have to make a claim on your insurance. But surety bonds are different. There is no expected loss. Like they expect you never to have to come to them and use the bond. Like there's no, supposed to be no loss on that. So, and it's also between 3 parties. It's just between you, the owner, and the insurer, and it's not between you and like a pool of people who are all putting their money together and working that way. So, do surety bond costs vary for different states? Yes. There's like basically it depends on the state and the country in which the city is. It depends on the size of the bond, so, and the rates all depend on the risk. So each state's going to be different. $5,000, $10,000 bond are going to have different rates. They're going to cost you differently because it's a percentage of that size of the bond. And some require, $5,000 bonds, $10,000 bonds for small jobs. What happens with a claim on a surety bond? So when a claim is made, let's say the owner claims that you have failed to meet your end of the contract, the surety is going to go in and investigate the situation because they're the ones who they're going to take up the brunt of the loss. So they're going to come in and examine, did you actually default on the bond? Did you not fulfill the requirements of the bond? Were there any changes made? Was it somehow, illegitimized by something that the owner did? Did they deliver the notice of default properly? Were there alterations or changes to the scope of contract? Were you overpaying the subs and therefore you couldn't complete it for the price that you bid? So you're going to look at all that and determine whether or not you actually defaulted. And that leads us to our next question. What if I actually default as a contractor? That's your worst nightmare. If that happens, you're probably screwed forever. Basically no getting out of it. If you're on a big job and you default, they're going after everyone. So yeah, if you want to get a bond, a lot of times you'll have to have people sign with you, and they could be family members, business partners, anybody, and anyone who signs on that, if you default, they're going to go after them until they get their money or you're dead. So yeah, it's not a good situation. Don't sign for a bond for someone else unless you're a business partner. Yeah, a real construction bond right there. Stay classy, Rinker. You got any questions?
Yeah. Any questions, please?
All right.
Thank you.